Hi class, this video is going to run through a quick summary of how to record in VCE Unit 4 Accounting Bad and Doubtful Debts. So if you're using the Macmillan textbook like my class is, this is all about Chapter 14. This video is not going to run through an exhaustive list of everything you need to know, but is going to hone on the important steps that you need to really remember, and particularly when recording, estimating bad and doubtful debts. So what is a bad and doubtful debt, and why do we need to consider this, particularly for the qualitative characteristic of faithful representation? Given what we need to understand when we're talking about doubtful debts, that there is no certainty that all the amounts owing from our sales, so our accounts receivable, will be collected. Because of this, we need to do two things. We need to make a prediction or have an allowance for doubtful debts, and we'll go through what that is in a second. And we also then need to record bad debts. So we need to understand what these two terms mean and know how to record these using our accounting process in Year 12 accounting of general journals and general ledgers. But what is an allowance for doubtful debts? This is the first one that you need to know. An allowance doubtful debts recognises that some amounts owing by accounts receivable may not ever be collected. So a certain percentage of what is owed to us will not be collected. An allowance for doubtful debts then is hence a negative asset account. And what I mean by that is we're going to recognise that some of our assets, accounts receivable, will not be collected, and hence we should, if we think about it, reduce how much that asset is. How do we do this? Through allowance for doubtful debts, which is a negative asset account, so it reduces how much we are owed. Importantly, this is a prediction because we never 100% know how much will not be collected. Businesses get really good at predicting, but it's still a prediction. This is different to a bad debt. A bad debt is an expense. So if we think about it, negative asset account expense created when a customer and our accounts receivable is written off as irrecoverable. Lots of key words there, but what is it specifically talking about that's different to allowance for doubtful debts? We know the specific customer that can't pay us back. So allowance for doubtful debts, a prediction that some customers can't pay us back. Bad debt, when we recognise that the specific customer can't pay us back. What's the difference? Allowance for doubtful debts is a negative asset and a bad debt is an expense. So we understand that they're going to be different things in different reports. What is the process? Firstly, we're going to establish an allowance for doubtful debt. We're going to establish our prediction. And then when we get to finding out which customers can't pay us back, we will actually write off the specific customer when they become a bad debt. So you might go on and go, must be 2 steps that I need to remember. There are actually 3 steps, and we're going to run through in 3 different slides each of these 3 steps, and then talk about one final complication, and that will give you most of the tools to be able to complete your bad and doubtful debt questions. So step 1. Firstly, we need to do the prediction. We need to establish and report an allowance for doubtful debts, create our negative asset account, and work out our prediction. Now, an allowance for doubtful debt is based on a percentage of net credit sales. It's a percentage because it's a prediction. And when you see net credit sales, this is always what we times our percentage by. And net credit sales is sales or credit sales minus sales returns, because sales returns are ones that have come back to us. These will never be needed to pay. They never need to pay us back, so they're not going to be ones that we can't collect the money from because they don't owe us any money. So let's look at an example. We have credit sales of $100,000, sales returns of $4,000, and 5% of credit sales normally go bad. We have enough information here to work out our allowance for doubtful debts. In this case, it is $4,800 of allowance for bad debts or allowance for doubtful debts. How have I worked that out? 96,000 times 5% or 0.05. 96,000 because net credit sales is credit sales minus sales returns, so 100,000 minus 4,000. How do I record this in my general journal? I have a template. My template is I'm going to do a debit and credit, and my debit is going to be bad debt expense, and my credit is going to be allowance for doubtful debts. I have a narration here, which you can memorize, because this will be our template. I'm doing an adjusting entry to establish an allowance for doubtful debts at X% of credit sales. Why are these debits and credits? If we think this through, I'm recording that my prediction that my assets are not worth as much as I thought they were, because some won't pay me back. What is my asset? Accounts receivable. So how do I reduce an asset? I do a credit. So this is my allowance for doubtful debts. I'm also going to record an expense, because this is essentially a cost of doing business, and an expense here is bad debt expense, and expenses going up is a debit. So how would I record this in my actual example here? By just using that template and plugging in the 4,800 that I've calculated. So I have an allowance for doubtful debts of 4,800 and a bad debt expense of 4,800. My narration slightly changes because I know the percentage that I'm putting in. That is your first step. We have now got an expense that would be reported in my income statement as an other expense. And I also have something that's reduced my assets. An allowance for doubtful debts is reported in the balance sheet as a negative asset. What do I mean by this? I'm still going to say that my current assets have included an accounts receivable, and you can see here it's $80,000. Now you might be going, how is it 80,000 when I had credit sales of 100? Remember, some are going to be paying us back as we go through, so this number is going to be different. But I'm going to record that I have an allowance for doubtful debts of 4,800, which means 4,800 are likely not going to pay me back. This means my current assets of accounts receivable at the balance date, in this case, reduced by 4,800 to 75,200. Step 2 is when we write off a bad debt. Even though we have established an allowance for doubtful debt, we've established our prediction and recorded an expense, the next step is to identify and record specific customers when they can't pay us back. So this is when I'm talking about writing off an account as a bad debt. So let's look at an example. I've done my step 1, but throughout the next period, I've discovered that Sam Smith has been declared bankrupt and he is not able to pay any of the money owing. This customer had a debt consisting of a credit sale of $3,300 including GST. So what does that mean? This customer has been recorded as an accounts receivable of $3,300. However, when this has occurred, we now need to reduce how much this customer owes us because they can never pay us back. It is no longer an asset. So how do I reduce how much a customer owes us? I am going to do a credit in the specific accounts receivable with the name there. If we're in the question, it doesn't require you to talk about the name, you wouldn't have to. It would either be accounts receivable name or accounts receivable in blank. The question should make it clear. What we are also doing is, you might remember, we have also already reduced our assets through allowance for doubtful debts. We're now going to remove that prediction of allowance for doubtful debts. How do we remove a part of it? By turning the credit into a debit. Because that prediction has come true, so we're crystallizing that. There is also some GST here, which we would not expect us to receive. We're not going to receive that GST anymore. If we're not going to receive the GST, we are not expected to pay it to the government. So the liability that we're expected to get, the GST we're going to receive, the liability being a credit, because liability is going up as a credit, is not needed. So we're going to reduce our GST. So in this example, I would have an allowance for doubtful debts of $3,000, GST clearing of $300, and Sam Smith cannot pay us back the full amount that he owes us of $3,300. Accounts receivable S. Smith goes down by $3,300, being a credit because assets go down as a credit. GST was $300, which we will not need to pay to the government, so our liability goes down, debit. And allowance for doubtful debts, where you had a prediction, we've now removed part of that prediction, so our credit becomes a debit. Why is this allowance for doubtful debts included here? Why are we not recording this as an expense? It is debited against the balance of allowance for doubtful debts, as the business has allowed for some bad debts to occur. We've already made this prediction, and the prediction in some part has occurred. So this is why we don't create another bad debt, because we'd be double counting. We've already, if you remember, recorded $4,800 of bad debt expenses. So we would be double counting if we recorded this as a bad debt expense. In here, we are just crystallizing that one customer can't pay us back. And this might make sense, and we go, I've done my 2 steps, finished. The third step is we need to adjust the allowance for doubtful debts for next periods, because accounting doesn't happen in just one prediction, we keep moving on. So we need to estimate the allowance for doubtful debts that should be for the next period. So to do this, we need to do a number of things. We need to take into account the estimate of bad debts for the next period. How much will we not collect in the next period? And most importantly, we need to look at the difference between the last period's prediction and the actual bad debt. So let's have a look at an example to continue this on. In the next period, credit sales were $110,000, and there is an assumption that there is no sales returns here. So we've had a good year period in terms of that. We've fixed the quality issue. An allowance for doubt should be 4% of credit sales. So you remember it's gone down a little bit now. The estimate for allowance for doubtful debts now is $4,400. 4% of $110,000 equals $4,400. So logically, we are then going to pick up this allowance and record it in our general journal following the first template from step 1. So we have done a credit for allowance for doubtful debts, recorded our prediction, and recorded our expense of bad debt expenses being our debit. We've done also our narration, adjusting entry for the establishment of allowance for doubtful debts of 4% of credit sales. But hopefully what's screaming out to you now is, my debit and credit are $2,600. Why the hell is it that when I've just worked out my prediction is $4,400? The answer is in the second part of this process. We need to look at the difference between last period's prediction and what actually happened. If we think about what actually happened last period, and this is what my ledger would look like for allowance for doubtful debts, I predicted there would be $4,800 of bad debts. There was only, if we assume Sam Smith was the only one, only $3,000 of bad debts. So what have we actually done? We've overestimated how many customers wouldn't pay us back. We overestimated by $1,800. So because we were penalized for a previous period, we should be rewarded for this period. So the difference of last period is an overestimate of $1,800, 4,800 minus 3,000. Therefore, the new allowance is $2,600 because we reward ourselves for making it being punished for this one. If we then think this through, we recorded 4,800 in the last period. We're recording 2,600 in this period. So that is $7,400 of overall bad debts that we're predicting. That equals the 3,000 from last period that actually happened. We don't need to worry about the prediction now. And the new 4,400 that we predict for this period. And this is where it then balances out. That is the 3 steps. There is, however, just one last complication that we really should be aware of, and this is called partial payment. Most often, and often in the real world this is more likely to happen, a bankrupt customer may make a partial payment on their account. They've gone bankrupt, but they do have a little bit of money, and by law they must try and meet all their payments as best as possible. So let's keep the same examples. If Sam Smith owed $4,400 but could pay 25 cents in the dollar, therefore, if the business would actually receive $1,100. So when this was then recorded, the accounts receivable of $4,400 would now no longer exist because it can't pay it back. It's no longer an asset. But we would recognize that we did get partial payment. So our cash, another asset, has gone up by $1,100. And then we continue on recording our allowance for doubtful debts and GST clearing here to recognize the crystallization of our prediction. And guys, that is how we record bad and doubtful debts as outlined in Chapter 14. 3 important steps. We need to understand how these work. We need to understand the definitions of allowance for doubtful debts and bad debts. Understand that partial payment is a common exam question. And by doing this and practicing lots of questions, we will become a master of, honestly, one of the more complicated parts of Unit 4 accounting. Keep practicing your accounting.